Hi, this is Marla DiCarlo, the CEO of Raincatcher. I am so excited to be talking to you today about this new program, Sell by Owner, and specifically Sell My Business. See, we believe at Raincatcher that small business and our clients are the heartbeat of America, and every small business owner deserves their chance at the American dream. At Raincatcher, we rapidly transform small and medium sized businesses into companies that are built to sell. And in turn, we help buyers find those remarkable companies. Unfortunately, we're not able to help everyone. See, those businesses that are below 500,000 typically can't afford our broker fee. And that bothered us. We wanted to be able to help every small business owner. And that's where Sell My Business comes in. This is one of the biggest decisions you'll make in your life, and we understand that. I remember when I sold one of my first businesses, and I can remember sitting there in the office conference room and thinking to myself, am I making a mistake? Have I thought through everything? Am I leaving money? Is this the right thing to do? So I get it. I understand the emotions you're going through. I understand the decision you're making to sell your business and the importance of that. And so we're going to take you through every process step by step to help you to maximize the value of your business and to help you to know exactly what you need to do, how you're going to handle buyer negotiations, how you're going to price your business, what the closing looks like. And by the time you're done, our goal is that you have no remorse over selling your business. You haven't left any money on the table, and you feel good about this next step. So let's get started by reviewing Sell Your Company 101, how to maximize your value. The value of your business will depend on your industry, location, and the state of the market. Depending on the size and age of your business, you can expect to sell between 1 and 4 times your annual seller discretionary cash flow. When it comes time to sell your business, it's important to set your personal feelings aside in order to do an accurate business valuation and establish a realistic and competitive sales price. You'll need to objectively analyze a business, study the current market, and consider, if you need to, employing a broker to help you come up with the appraisal. So let's get started by discussing the basics of how you're going to value your business. The most common valuation method for businesses under $1 million in revenue is to use what's called the owner's discretionary cash flow times a multiple. See, every small business owner has 2 sets of books. The first set of books is used for minimizing taxes. It's very common for small business owners to write off various expenses and to run through costs that aren't always necessary in the operation of the business. We want to be able to pay our taxes, but let's face it, it's very expensive, and so most small business owners reduce that tax burden by reducing and minimizing the taxes they have to pay. The other set of financials is your management set of financials. That means that is reflecting the true operational performance of the business. It shows the income that you were able to generate through your services and products. It shows the costs that were associated with generating those service and products. And it shows the overhead, the general and administrative expenses and selling expenses and other expenses that are necessary for the operations of your business. Calculating owner discretionary cash flow means that you're going to take your net income before income taxes, and then you're going to add back expenses. That includes adding back interest expenses, depreciation and amortization, owner compensation, that includes salaries, wages, bonuses, car allowances, health and life insurance, any benefits in relation to the owner. You're going to add and subtract non-recurring one-time expenses and income. You're going to add back any compensation that was paid out to family members or close friends that are not actually working in the business, but you were able to pay them something to help them out. Again, think of that minimizing your tax burden. And also add back any personal items that were paid for by the business. In the end, what happens is you end up with an amount of cash over which the owner has discretion, or what is the true operational performance of the business, the actual cash flow of that business. Next, you're going to determine a multiplier to times against your seller discretionary cash flow. So how do you calculate your multiple? Well, there's many ways to do that, but we think the easiest one is to use our multiplier calculation worksheet that we provide in our courses. It's going to ask you a series of questions and you're going to rate yourself. And in the end, it's going to give you a multiple that you should use to times against your seller discretionary cash flow. Now, one thing I'm going to remind you, and I'm going to say this often, so please remember this. Remember that a business is worth what a buyer is willing to pay. Another way to say that is that a business is worth what market will bear. If you overprice your business, you'll be sorry. Because what will happen is you will turn away buyers that were serious in buying your business, looking at your business for further, asking more questions. You'll turn them away because overpricing your business is an immediate red flag to a buyer. So it's really important that you spend time on calculating the value of your business, and the best way to do that is what I've explained so far. Another way you can price your business is that you can look up comps, other businesses that have sold by your industry code. That is your NAICS code or your SIC code. And by looking up your industry code, you are able to look up comps that have sold recently and in the past. I wouldn't go past 3 years because that doesn't really have a lot of value. But then that helps you to understand what your asking price should be. You can also research comparables via BizBuySell in your industry. And so by typing in your industry and doing a search on comparables, you're able to see businesses that are listed for sale currently and businesses that have sold. And then using that information, that will help you to give you a baseline of where you should be pricing your business. Finally, another way to price your business is to calculate your multiplier by using the rule of thumb. Lower cash flow businesses, meaning under $1 million, typically use a multiplier of somewhere between 1 and 2 times seller discretionary cash flow. A higher cash flow business, meaning those businesses with $1 million in revenue and above, typically will sell somewhere between 2 and 4 times seller discretionary cash flow. Most businesses sell for somewhere between 2.5 and 3.5 seller discretionary cash flow. It is also important to take into account factors that reduce the value of your business and reduce your multiple. Some of those factors include competition. If you're highly regulated or you have a lot of licenses in the type of business you run, a high concentration of customers, product or service lines, supplier relationships, your market position, management and employees, a physical facility, and if you have operating inefficiencies or efficiencies, and then your reasons for sale. Now we're going to go into this more in further courses, but I really encourage you, if you haven't already, to take the Value Builder assessment to determine what your overall score of your business is, and also your driver score in the 8 key Value Builder drivers. And what that will do is that will help to give you a baseline of factors that you may want to focus on before you take your business to sale. And then you may want to consider looking at our Prepare My Business product that we offer. And if you do have lower scores and you choose not to work on increasing the value of those scores, then you need to take that into account when you're pricing your business and when you're determining your multiple. Next, there are 2 types of purchases when you're selling your company. One is the asset purchase and the other one's a stock purchase. In doing an asset purchase, the seller remains the legal owner of the entity, while the buyer purchases individual assets of the company, such as equipment, licenses, goodwill, customer lists, and inventory. Asset sales generally do not include purchasing the business's cash, and the seller typically retains the long-term debt obligations. Such a sale is characterized as cash-free and debt-free. Normalized net working capital is typically included in the asset purchase agreement. Net working capital in an asset purchase is comprised of items such as accounts receivable, inventory, and accounts payable. A stock purchase is simpler in concept than an asset purchase. Therefore, in most instances, it's just basically an easier, less complex transaction. The acquirer buys the stock of the target or the business, and it takes the business as it finds it in regards to both assets and liabilities. Most contracts the business has, such as leases and permits, in effect transfer automatically to the new owner. For all of these reasons, it's often more straightforward to go with a stock purchase rather than an asset purchase. However, it's really important when you start the sale of your company that you talk to an attorney and you also talk to your CPA. So as I mentioned, make sure and sit down with your CPA prior to selling your business so that you can discuss tax implications and your final payout after the transaction closes. Some of the tax consequences of a sale include that the proceeds to the seller will be taxed, and the taxation level will be either capital gains or ordinary income, dependent on the classification of the asset being sold. Ordinary income tax over $500,000 is typically around 37%. Capital gains over $500,000 is typically around 20% for the federal tax. So, as you can see, it's obviously better tax implication to have capital gains. However, it's not always possible. So whenever it is possible, you want to hold on to an asset, meaning your business, for a year or longer so you can qualify for the long-term capital gains tax rate. It's significantly lower, and it's important to take all of this into consideration before you market your company. So how are you taxed on the sale of your business? Well, taxes associated with a portion of the proceeds from the sale of, say, inventory and recapturing depreciation on fixed assets, non-compete agreements, and employment and consulting agreements are typically taxed at the ordinary income tax rate, where taxes associated with a portion of proceeds from the sale of customer lists or goodwill are typically taxed at capital gains tax rates. Depending on the circumstances leading to the sale of your company, you may have the luxury of being able to time it correctly. If you do, it's important to sell your business at a time when it's profitable, when it's been on a steady incline for a while. If profits have begun to dip, Potential buyers will be suspicious and they'll ask questions. A business that looks like it's still growing will be much more attractive to a potential buyer. It is tempting to hold on for a little while longer to reap the rewards of a huge contract that you just closed, or maybe an opportunity that you feel like is going to take place. Don't. Sell when the perceived value of your business is at its highest. If you have just secured a great client or received some good press coverage, now is the time to sell. The general rule book for selling your business is, once again, a business is worth what a buyer is willing to pay. Remember that. That is really important. Don't overprice your business. Use the seller's discretionary cash flow to value a business. And when you're calculating your multiple, use the rule of thumb, such as lower cash flow is 1 to 2 times seller discretionary cash flow, and higher cash flow businesses are sell for a multiple of 2 to 4 times seller discretionary cash flow. Another thing that's important is terms are more important than price. The ideal equation for a down payment on the asking price of your business should equal somewhere between 1 to 1.5 times your actual cash flow. Remember, the seller wants to sell and the buyer wants to buy. That is really important. And each party has their own objectives for buying the business. And then finally, most deals will fail during negotiation at least 2 to 3 times. Do not give up. We will go over this more in the future courses, specifically in negotiation tactics. But just remember that selling your business is one of the most important decisions you're going to make in your lifetime. And it's also one of the hardest decisions you're going to make. And so it's important to prepare yourself and ask questions and go through a course like Sell My Business. I used to tell my business owners when I was consultant that knowledge is power, and that is so true. The more you know, the more educated decisions you can make, and the better you're going to feel after you've sold your business, that you made the right decision and that you went through the right process. I look forward to helping you through these next steps. And if there's anything I can do, anything my team can do, please reach out. You can schedule a time with us through our scheduling link, or you can look up one of our coaching clinics that we offer during the week. But whatever you do, just remember that you're not alone and that we're here to help you. And we are cheering for you, and we are just as excited as you are to help you sell your business.